Everybody likes to ask the question of how high the price of gold can go. And it even helps with planning. You just have to consider there's always a downside risk as well. So we're going to give that side a go and consider how far gold could drop. New fears of recession and even stagflation are hitting the news cycle again. And with the market hitting a technical correction, meaning a 10% drop, the question of what happens to gold is back to being top of mind. And part of that is because what happens to gold, or what you might expect to happen to gold in a market correction, is not happening right now. We didn't see gold correct with the market. What we actually saw is probably best shown with the chart. We saw gold continue to climb. So far this year, we're up something like 15.9%. That is not a correction, and that doesn't help us answer the question of what could happen to the price of gold. So we're going to take a look at some historical gold price corrections just to get an idea. Quick shout out to channel sponsor Summit Metals. If you're looking for gold or silver, they have you covered. Great prices, fast shipping, wonderful people. SummitMetals.com. Now, one thing we need to point out here is that we are not in a recession. There's just a concern that we could see one, and in that phase, the pre-recession phase, the fear of a recession phase, gold price doesn't go down, not typically anyway. Now, if a recession leads to deflation, gold could drop because cash becomes more valuable, and if the market actually does crash, well, we could expect to see gold follow as investors sell gold for liquidity. So if a recession leads to that kind of high liquidity stress, gold could see a correction. Now, I'm not sure a crash is on the table, but we're going to look at points in time when gold actually did crash to give us an idea of just how far it could go. Okay, so let's go back to the 80s. Look past the neon jackets and the mullets. Gold price fell from $850 an ounce in January of 1980 to about $300 by the mid-80s. That's a 65% correction. What caused it for those who weren't there? Well, the Federal Reserve raised interest rates to 20% to combat inflation. That's one. Think about that, 20%. Compare that to the 4.5% we're complaining about today. It's a different case entirely. Next up is an important one that affects that 21st century comparison between gold and the stock market chart that I show off and on. There was a 38% correction in there from 99 to 2001. So from $400 an ounce in 1996 down to about $250 an ounce by 99, which just happens to be when the UK started dumping a bunch of their gold holdings, selling 395 tons of gold, approximately 58% of their holdings. So if you've ever felt bad selling your gold at the wrong time, well, the UK has you beat. Now, that wasn't the primary reason for the crash. US economic growth was on a tear with the dot-com boom, so there was just less demand for gold. Now, jump forward to 2008, we saw a 30% correction. Gold prices fell from about $1,000 an ounce to $700 per ounce in October of 2008. Now, this would be the typical liquidity stress that you'd think about. The Lehman Brothers collapse and the financial crisis caused that market-wide liquidity crunch. Investors sold gold to cover losses. No surprise there, 2008 was pretty chaotic. Now, let's move forward to 2011. Gold prices fell to $1,050 per ounce in December of 2015. So if we look at the high in 2011 to the low in 2015, that was a 45% correction. A big reason there was the U.S. Fed signaling interest rate hikes that led to strengthening the U.S. dollar. Stock markets recovered. Gold lost a little bit of its appeal. Now, we're going to move forward to one you might have actually missed. We saw a 19% correction from August of 2020 to March of 2021. A reason given, of course, COVID recovery. So that was a lot of time staring at a chart. We're going to recap 65% in the early 80s. I have trouble considering that one to even be relevant with everything going on. 20% in 1999. Maybe that one's relevant. 30% in 2008. That's a really good example of what happens in a liquidity crisis. 45% in 2013. It's kind of a big one in my head. And then 19% in 2022. Kind of a sleeper crash. And technically that one was still a correction. So if you use those examples from recent history as guides for what could happen to the price of gold, well, you could take the spot price of gold, you could apply some percentage correction to it, and you could come up with a possible near-term low. Only we can't really, because there's just no reason to think that today's spot price is the high for this rally. Now, what doesn't get covered when we just look at these numbers is what happens leading up to the crash. There's some amount of the crash that's always fed by over exuberance leading up to it. You can see that in each of the cases that I mentioned. Big run up, big fall down. And if we're looking for patterns, what we're seeing today is definitely another steep run. But the catalyst that we're looking for to push gold higher, like lower interest rates and maybe the results of some kind of trade war, still hasn't hit yet. That's why the big banks are all raising their price outlooks for gold in 2025. So I guess what I'm saying is I don't think there's any reason to think the 43% spike in price that we've seen over the past 14 months or the 140% since 2019 is the last leg of a rally and we're at the top. It's just more likely that if we're going to experience a crash in price, we still have more to the spike ahead of us first, and the same is probably true if we're going to see a correction. So I wouldn't say the low end of what we might expect for gold price is 20 to 45% lower than today's price, but it's possible it could be 20 to 40% lower than some kind of eventual top. So if you want a more likely case of a possible worst case price for gold, and you want to use past correction levels as a guide, well, you need to first find a top. Now, Citi just raised their price target for gold over the next 3 months to $3,200, and they also give a bull case of gold price reaching $3,500 by the end of the year. So in a worst case scenario where gold ends its rally at the end of the year for I don't know what reason, and we use Citi's price prediction of $3,500, well, a 20% crash would mean $2,800 for gold, and a 45% crash like we saw from 2011 to 2013 would mean $1,925 for gold. That would take us back to prices from 2019. And between friends, I just can't even come up with a case where that seems at all possible. So let's look at a 20% crash on $3,500. What that would mean is that we would see the $3,050 today being about 8% higher than some kind of eventual low. Is that helpful? I don't even know if that kind of math actually makes sense. I see bank analysts giving conservative estimates for gold at $3,050 by the end of the year. Just happens to be where we are right now. Even $2,960 by the end of the year is kind of a low end for where analysts seem to think that gold might go. Now, I don't know that I agree with that, but I'll allow it as a conservative side of a band. And if we use estimates from the same people, you'd have $3,500 as the high side of that likely band. Now, widen that scope out. There are even a few cases out there for gold rallying all the way up to $8,000 before correcting. Now, that feels like a little bit of a stretch to me, but either way, you'd still have to say that there's a long way to go from where we are today. So let's call it good there. Let us know if you think it's time for a pullback. I think you're going to be in the minority if it's more than just a hope for you, but let us know either way. And then while you're in the comments, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you want to hear more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.